Bill Belden, why is it better to have a laddered bond portfolio, especially during a rising rate environment?
Greg, it's really interesting. What's old is new again in many respects, and we find that bond laddering has been a particularly effective tool for our advisor clients to address interest rate risk in their portfolios, which everyone is now seeing on the horizon. It seems to be much less of an if and rather a when, and maybe by how much. So when you think about constructing a ladder, well, and again, the ladder is basically allocating your assets across a set of maturities or exposures. And then as those exposures mature, you reinvest, redeploy those proceeds into later dated maturity. So really what it does is it gets out of the predicting game of what's going to be happening with interest rates and provides a very constructive and effective way to allocate fixed income assets.
Well, Guggenheim has a lot of fixed income funds ready to be placed on the rungs of those ladders. What's the best way to do it?
We have a suite of defined maturity ETFs. We call them the BulletShares ETFs, and they're perfectly situated to deliver upon a laddered exposure. What the beauty of the BulletShares ETFs are is that they have a finite life, i.e. they mature, similar to an individual bond maturing. So they wed the best aspects of owning a bond ETF or a bond fund with owning an individual bond. So when you're seeking that very precise exposure across maturity years, using the BulletShares or defined maturity ETFs, which have availability in years between 2015 and 2024 on the investment grade side, can provide that type of precision that makes a ladder easy to execute on.
Well, Guggenheim also has a Spinoff ETF, which has done very well over the past few years. The ticker is CSD. Can you just talk about why spin-off companies have been outperforming the S&P?
Sure. We launched CSD back in 2007, which really sought to deliver upon some empirical analysis and evidence that supported the fact that companies that are actually spun off from their parents actually outperformed during a particular period of time post-spin-off. So the index methodology that CSD tracks really provides that exposure to a company between the 6th month of the spinoff and the 24th month of the spinoff, or the 24-month period between the 6-month and the 30-month ending date. And it's shown that holding companies during that period after they're spun off has delivered that type of value relative to broad market indices.
And then finally, we've seen growth outperform value so far this year. Do you expect that to continue? Because I know this is something you watch over at Guggenheim.
Yeah, we have a suite of pure style ETFs, Greg, that really deliver upon a pure exposure to a style, whether it be growth or value. And certainly we've seen growth outperform value. Obviously, there are long-term studies that have shown that growth underperforms value during certain periods as well. So depending upon what an advisor's outlook might actually be, we offer the tools to be able to allocate to client portfolios to take advantage of that in a very pure way, which contrasts with the typical growth and value exposures, which actually blend with each other. So the purity of the index that these funds really track takes advantage of that outperformance of growth, and that's taken place over the course of the past several years, frankly.
All right, thanks a lot, Bill.
Great to be with you.